Okay. Before we get going on finishing up with Chapter 5 and going over some of the exercises, I just wanted to touch base with you again on the midterm, and that is going to be on March 4th. So that gives us today and next Tuesday to finish up the material, and I think we'll be able to do that. The one thing that I would like to ask you all about is in terms of I often do a group office hour, so think of it as a review session. It's totally optional. There won't be any new material during the review session, but if you all would like to do something like that, is there a particular day that would be better than the other? I mean, we could do something even as soon as, say, Sunday evening, if you plan on doing some studying over the weekend, which I would definitely recommend. Or we could wait till Tuesday evening or Wednesday evening and do something there. And by the way, I should also mention, this group office hour, if you will, or review session, doesn't preclude any other interactions, and I can set up Zoom meetings, or we can just do things via email and that sort of thing. So that always is on the table, but this is just something extra. I think there's some value added in terms of sitting with your colleagues. They might ask a question that you hadn't even thought about, and so there certainly is some value in that. So in terms of day preference, Sunday, Tuesday, Wednesday, any overwhelming preferences there? I'm guessing maybe Wednesday would be better. Is that? I see a number of heads shaking yes. Okay, let's go with Wednesday. I mean, like I said, if something comes up over the weekend as you're studying, shoot me an email. At the very least, I can, if it's a relatively simple question, I can respond to it via email. If it's more complex and requires some feedback from you, we can even set up a Zoom session over the weekend. So I'm available for that sort of thing. Okay, time-wise, what time works out for you all? I'm pretty open. Would 5 to 6 be good, or do you want to do more like 6, 7, or 7 to 8? Any strong preferences? How does anybody have a class that runs past 5 or an activity? So how about 5 to 6? Oh, Patrick, I saw you raise your hand. Do you have something? How late does your activity run till?
I'll probably have to miss the whole thing. Will it be recorded?
Yes. Yeah, it will be, for sure. Anybody else have anything after 5? Because we could just do 5 to 6 and I'll record it. But the key thing is nobody comes to it, there won't be any questions. So I'm not preparing anything for this. I'll just be here to answer questions, go over homework, that sort of thing. All right?
I know I have practice until 5 on Wednesday, so if there's any way that we could do maybe just a little bit later,
Okay.
I would appreciate it. I don't know how anybody else feels.
Yeah, we could start at 5:30. Would that be better? 5:30 to 6:30?
Yeah, that'd be great.
Okay. All right. Let's do 5:30 to 6:30 Wednesday evening. And as always, if there are even if you're working together in a group and you want to do a Zoom session at another time, that's perfectly fine with me too. Just let me know and we'll get it set up. So March 4th is the midterm. It's going to be on a lockdown browser with the video, whatever they call that thing. I forget the term that they use on that. So make sure you've got a camera. Make sure that you're prepared to do the lockdown browser thing, that you've got a nice quiet spot to take the test. It will be predominantly multiple choice and matching. I have tried in the past to do problems, and in this setting, I found it not to be very helpful. So unfortunately, it's going to boil down to multiple guess and matching. The matching will be terminology, and so in your chapters you can go through term by term. If you hover over a term, it'll pop up the definition for you. So that's a great way to study for that. The multiple guess will be a combination of both theoretical and conceptual as well as analytical. So going back over the chapters, reviewing the big issues that are brought up in each chapter, and then going back through the homework problems, going back over the applications that we're doing in class. We're going to continue that today, and that's pretty much it as far as studying for the exam. I would also like to start off before we finish up chapter 5. There were a couple of questions. I think Luke and Brett both had posted in the discussion forum. Okay, so this problem, let me blow it up a little bit so you can see it more easily. All right, so we're looking at various types of investments, and we're looking at calculating a return here. So we've got $90,000 to invest. That in this particular question, since the answer is in percentage terms, that $90,000 is pretty much irrelevant. You could use it, but then you're just typing in 4 more zeros, which is unnecessary. So the way I'm going to show you is to just calculate it based upon a per share basis. All right, so we've got Miller Moore Equine Enterprises, MMEE, ticker symbol, is currently selling at $90 per share. And you also notice that there's a call option with a strike price of $90 and 6 months to maturity, and that's selling for a premium of $4.50. Get my calculator here. So we want to get the return on each of these, given that the price either finishes at $97 or at $86 per share. Obviously, if we're buying something at $90 and it finishes at $86, we know that's going to be a loss. If it finishes at $97, that should be a gain in both cases. So we can at least kind of have a kind of a gut feel for whether we're getting a correct answer here. Now, in the option example, we have our initial investment is the $4.50 premium that we're paying for this. So that is what we're starting off with. Now, at $97, we get to buy this thing. So this is a call option, so it gives us the right but not obligation to buy at $90. So if it's selling in the marketplace for $97, we can buy the same stock for $90 and then turn around and immediately sell it for $97. That gives us a $7 gain. And so I'll just move that down here. And then I'm going to subtract from that my $4.50 premium. And that's going to give me a $2.50 gain. All right, so, and then what's my percentage gain on that? So move this down here, and I'll divide that by the $4.50 initial investment. And so I have a percentage gain of approximately 55.5%. All right, you see where we're at right now? So my guess is that you probably got to that point. It's annualizing it where more than likely the problem came in. All right, so let's let me write this way: 1.55556, and to make that on an annualized basis, this is over a 6-month period, we're assuming, because the option expires in 6 months. So there are 2 periods in the year. So we're going to take 1 plus that periodic rate right up here and raise it to the second power. Let's see if that works. All right, that works. Then we're going to take that 419767. We're going to subtract back out that 1, and that is going to give us 1.4197. Now, that's the percentage return, actually. So to read that, we simply multiply this by 100, and that gives us the 141.97 percent return that we see over here. And actually, they're rounding up to 0.98. And I had some decimal places to the right of that 7, so I could easily have rounded that up properly. So that's how we annualize it. Now, the other direction, if we have, scratch all of this out. If we have a share price of 86, and this is in the option case, if our share price is 86 and our exercise price, doggone it, this is really irritating. Okay, our exercise price is $90. We don't exercise. So this one is easy. It's a total loss. We lose the $4.50 entirely, so that's 100% loss. Now, 100% loss is the one case where we don't do anything when we annualize it. 100% loss on a 6-month basis is 100% loss on a 1-year basis. So that's how they come up with this just negative 100. So that's one exception to this rule that we've been doing, where we compound it over the number of periods that there are in a year. So that's the option. If we go to the stock investment itself, here we have, so let me clear this off. Here we have $97 minus our original investment of $90 gives us, what the heck is going on here? Man, oh man, this is really, really irritating. Sorry, guys. I think it's maybe it's confusing with my hand on here. I'm not sure what the deal is. Come on. So 97 minus our 90 gives us our $7 gain, and $7 on a $90 investment is about a 7.7778% return. So when we annualize that, 1 plus 0.0777778 equals that. And then we're going to square that again and subtract 1. And that gives us our 16.16% return. And we do a similar thing for the $86. Now, $86 means that we've lost $4. So that gives us a negative 4.444% return. And I'm just going to get rid of this mess here. So I've got some space to work. And so with that 1, and that's a negative 444. And I'm still raising it to the second power, still subtracting off the 1. And that should give me that 8.69% negative return annualized on that problem. So the trick here is to make sure that you're annualizing it. I think that's probably what was happening there, Luke. Did that help out?
Yeah, it did.
Okay, great. Sure. No problem. Now, if I can just get my iPad to work here and cooperate. Play nice. Okay, so now let's go on. Brett had a couple of questions too. This was out of chapter 6, I believe, and it was problem 6. So this problem says we've got various prices, we've got EPS, we've got cash flow per share, we've got sales per share. And so the basic setup is we want to figure out what the value of the stock is based upon a PE relative valuation, a PCF, and a PS relative valuation. We're going to use an average historical growth rate for each of the denominators in that. So the earnings, the cash flow, and the sales. I figured this was easiest done in a spreadsheet, so I put together a little spreadsheet here. And so here we have, I've just copied over the data that we had in the table there. So back in 2014, we had a price of $58.10. 2015, 64, and so on. And here was our EPS, our cash flow per share, and our sales per share. Then down here, I calculated, and you can see the calculation, and I don't know why it's not highlighting like it does normally in a laptop, but I guess that's the Excel app on iPad. But obviously, PE is we're taking price divided by earnings, and we come up with a PE of 12.7973. We do a similar thing you can see where we get the PE. It's cell C4 divided by cell C5, likewise PCF and PS. Then over here on the far right in column I, I've taken the average of those. So we've got an average PE of 11. An average PCF of 6.87, an average PS of 1.81. And then down in the next three rows, 11 through 13, I've taken the growth rate in EPS, CF, and sales, respectively. So I've simply, for this cell, if you look down here to cell D11, that's first EPS growth rate, that's simply the 2015 value minus the 2014 value all over the 2014 value, just like you'd calculate any percentage change. I've averaged those up over in column I. So I have three averages. The EPS growth average historical rate is 13.64% and 11.23 and 14.71 respectively for CF and sales. Then I'm simply using the formula for relative valuation. Now that formula is the most recent EPS, so that would be out of 2019. We have $8.60. We're going to grow that at our expected growth rate, which in that case is the 13.64%. So 1 plus 0.1364 times the $8.60. And then finally, we're going to multiply that result by the 11.05 average historical PE. And that gives us a price of 108 and a penny. We're doing similar things, and I'll post this spreadsheet for you all if you want to just look at the formulas in there. I apologize for the lack of functionality here on my iPad. I think that's problem 6. Problem 7, I also did a spreadsheet for that one. And here's problem 9 out of chapter 6. So this one is a valuation problem again, but here we're using the dividend discount model. And when we read through the problem, it's obvious that we're going to use the two-stage because we're given two different growth rates. So we have a most recent dividend of $2.35. We have a growth rate of 17.5% for the next 5 years, and then it drops down to 12.5% for there on out to infinity. We've got a required rate of return of 15.5%, and then you're asked to calculate the value of the stock, and we're looking for a value of 108.40. So if I go to my spreadsheet here, I've input the dividends per share. The two growth rates are here. And then over here, what I've done is I've taken the formula, and here is the formula for the two-stage dividend discount model. So remember when we talked about this before, we had we had broken it up into two pieces, that term to the left of the plus sign, the two ratios there, and then to the right of the plus sign. So you can think of that first term, that is the value of the stock for 5 years. And then you can think of that second term, at least vaguely, or in a very loose sense. You can think of that as from year 5 on out to infinity. So when we plug that into the spreadsheet, what I've done is I've broken this up into 3 different steps. So if you look over here to where I have the price at time 0, here's the first growth rate. That's the 17.5%. Out of that first fraction, I get a value of negative 138. And out of that second fraction, I get a value of negative 0.089. And then I multiply those two together. And so that first 5 years of value gives me something around to the somewhere in the neighborhood of 12.37. And then I do likewise for the term to the right of the plus sign. I break up that fraction into the two pieces. So I have 1.089 is that it's 1 plus the growth rate over 1 plus k raised to the 5th power, because t is 5. And then that last piece of it, which is the value of the firm on an ongoing basis. And then I multiply those two together, I get 96.02. And when I add the 96.02 to the 12.37, I end up with 108.39, round that to 0.4. The only other trick here is they say, well, let's change that to 0.205, so 20.5%. And here again, I'm not sure why this is not cooperating for me, but trust me when I tell you that when I do make that change, I end up getting the number that they have here, the 40.03. And again, I'll post this spreadsheet for you all so you can look at it and see how those formulas work. So hopefully that helps out on both of those questions as well. Feel free to post any other questions that you have. And again, I do apologize to both Brett and Luke for not being more responsive on those. But hopefully this has helped improve the understanding there for all of you. So let's get back to finishing up chapter 5.
Professor, are we allowed to use Excel during exam or just calculators?
I'm going to have you just use calculators, and I'm going to make problems accordingly. All right. I will allow you to have a piece of scratch paper. The problem I've found with the lockdown browser and Excel is that it doesn't seem to always work for everybody. So to try to make this as level a playing field as possible, I will allow you to have a piece of scratch paper. You will have a formula sheet available. And by the way, that's posted on the in the module section. But here's the formula sheet that you'll have access to. I think what I'm going to have you do, now there's even a facility where I could post this in the lockdown browser. I may try that. I've got to do a little more experimenting to find out whether that's going to create more problems than it's worth. What I did last semester was I just had folks print this out. And I said, look, just put this printed copy on your desk so when you do your scan, I know that's going to be there. And I also know that you're going to have scratch paper. But take a look at the formula sheet. If there's anything that you'd like to see added to that, let me know. I'll consider adding additional items to there, as long as they're reasonable.
So with those problems that we just went through, the number 6 and number 9, you should be able to do those with competency without Excel.
Yes. Yeah.
Okay.
Yeah, and the one that's going to be the most problematic would be obviously that 2-stage. Now, in terms of the relative valuation, I'm not going to have you do, 3 different ratios and 5 different years. The problem is going to look more like what you see in the homework. So it's going to be, you've got at worst case scenario, it might give you a 3 years of PE, get the average. Probably will give you a historical growth rate so that you don't have to compute that yourself. And then it's just the most recent EPS times 1 plus that growth rate times the historical average of the PE. Or maybe we've got an average of peer groups for the PE. So it won't be anywhere near as complicated. I think that just get kind of practice up on using the store and the recall for the 2-stage. That comes in handy there. So when you're doing that, those fractions, you can store that first fraction, the second fraction, and the third and the fourth fractions in the memory, and then recall those and put them all together at the end. It's probably the most parsimonious way to handle that. Depends on the calculator, obviously, but if you've just got a BA2 plus, that's how I usually use that calculator. All right, so now hopefully, oh yeah, hey, finally works. At least PowerPoint is working all right on here still. One thing that I jumped past and I wanted to come back and catch up on, 2 items here. This illustration of the flash crash back in 2010. The flash crash is important because it showed how susceptible markets are to a potential small error that can be easily compounded by algorithmic trading. Algorithmic trading is simply computerized trading, right? So there's no person directly behind the trading. There's a bunch of rules encoded into programming language, probably Python, something of that nature. And the data gets fed into that program, and ultimately it makes buy and sell decisions based on that. So this is 1 day, mind you. So the market opened up here, and within the course of less than an hour, it went from up here at 10,800 and dropped down to 98.69. And you can see that most of that drop occurred just in a matter of a few minutes. It was incredible. I was watching this thing, and CNBC, the anchors on CNBC were just going nuts. They couldn't believe what was happening, and nobody could actually, frankly, because there was no news. There was nothing to drive this. Yet the markets just cratered. So there are means of protecting the markets from this sort of random error, and they're called circuit breakers. So this particular event actually told us that we really need to do a lot more work on our circuit breakers. In fact, the NYSE updated their circuit breakers to try to eliminate a repeat of the flash crash of 2010. So far, it's worked. And here's the way circuit breakers work. If the market drops by a certain percentage, depending upon the time of day, there's a pause. So essentially trading is halted, and it could be market-wide. We have circuit breakers on individual securities as well, so it could just be on a particular security. And the point of the halt is to really kind of raise a flag and let the whole market know, hey, look, we got a problem over here. Could be some liquidity issues. You might want to come over here and have a peek at it quickly. Bring some dollars with you. That's basically what a circuit breaker does. And there are circuit breakers in markets all over the world. In fact, the Japanese stock exchange, the Tokyo Exchange, is interesting in that its circuit breakers implement quite regularly. They're on relatively low frequency or relatively low percentages. And they don't have specialists or DMMs in their marketplace. And as a result, they use this circuit breaker to kind of draw attention to stocks that need liquidity. Seems to work over there. So we have kind of a blended system. We have the DMM, we have the designated market maker, which is there to help move the prices on a fair and orderly basis and provide some additional liquidity. But then we also have circuit breakers for when things go really crazy. So I just wanted to mention those things to you. They're a very important feature in the market. All right, so we stopped right here. We've already talked about third and fourth market transactions. Dually listed or multiple listings are also quite frequent. So there may be a primary listing on, say, the NYSE, and the stock that's trading might also be listed on the London exchange, might be listed on the Tokyo exchange. So this is not uncommon these days. 30 years ago, the exchanges had a little more power, and they basically said, you're listed with us, and that's it. And even the NYSE can't uphold that rule anymore. They'd like to, I'm sure, because really, remember, a lot of this is all about order flow. They get value out of order flow. Price efficiency is greater with order flow. By having dual listings or multiple exchange listings and trading around the clock, we reduce that order flow per unit of time, and potentially that impacts negatively on the price efficiency. In terms of how do we figure out what's going on in the market per se, well, we have these things called indices. And of course, the most well-known indice is the Dow Jones Industrial Average. That's 30 stocks. And another one is the S&P 500. It's a much broader based index. But the way these indices are constructed is what's going to be most important to us in this part of the chapter. By the way, here are I pulled this up just, I guess this was just the other day, and these are the Dow 30 stocks in here. So we've got American Express, Apple, Boeing, Caterpillar, and so on down the line. Kind of the companies that you would expect. Now, I want you to pay particular attention, though, to these share prices. So, for instance, let's look at Apple at $125 per share, and then let's compare that to Goldman Sachs at $330 per share, or United Health Group at $332. Those are among the higher priced stocks in the index. And what you may or may not know about the Dow Jones Industrial Average is it's what we call a price-weighted index. And by price-weighted, it simply means that the amount of money that we put into any individual stock in that index is a function of its share price. That makes constructing the index extraordinarily easy. So if I want to replicate the Dow Jones Industrial Average, I can do that with very little money because all I have to do is buy one share of each company. So just add up all these share prices. That tells me the minimum amount that I need to replicate the Dow Jones Industrial Average exactly. It's a great, it's really nice, very handy in that regard. What is less handy is share price really representative of the weighting scheme that I should have in these particular securities? The answer to that question, in my mind, is no. There's no bearing. It's completely, well, it's not completely random, but it's not necessarily related. It's certainly not related to market cap, right? I mean, look at, obviously the market cap of Apple is quite a bit bigger than Goldman, and I'm sure it's quite a bit bigger than United Health. So shouldn't I have more weight on Apple than on either of those two? But in fact, in this way of constructing an index, I actually have nearly 3 times the weight on those other two that I have on Apple. But if I really want an index that's representative of the economy as a whole, it seems like there might be a better way to weight this. So let's, and actually here, I just pulled this out of the terminal. Here's the Dow Jones Industrial Average from beginning of 2016 on up. Oops, and here are some of various other indices. I'll let you go back and browse those for yourself. But the answer to the question about price weighting, while it is easy to replicate the index and I can do it with very little money, it's not so clear that that's representative of the economy. And isn't that what I really want in an index? I want something that's going to represent how the economy is doing. And there, for that, I need a valuated index. And the most well-known valuated index is the S&P 500. So the way I determine how much to put in each stock in a valuated index is I simply take the market cap of all the stocks in my index. In the case of the S&P 500, 500 stocks, 500 market caps. I add all those suckers up. Then I get an aggregate market cap for those 500 firms. That's my denominator. And then so if I want to figure out how much to put in Apple, I get Apple's market cap, and I divide that by the aggregate market cap of all 500 firms. And Apple is going to wind up being somewhere in the neighborhood of what, 1.5%, 2%, somewhere in that neighborhood, right? Because it's huge. It's not going to be 1/500th%, and it's not going to be like the Dow Jones Industrial Average, where it's much smaller percentage than some other very small companies that have much less impact on the economy. So that's how a valuated index is calculated. So I would argue, and this is kind of my constant pet peeve with the media and the way they portray the economy, almost every news report you hear, you'll hear them referring to the Dow Jones Industrial Average or the Dow 30, right? Virtually every one of them. How many of them actually refer to the S&P 500? Many fewer do. I mean, sometimes they'll give you both, and they'll talk about the market being mixed. No, the market's not mixed. The S&P 500 is the right index to look at. If you really want to see how the economy is doing in the U.S., forget the Dow. Why do we always hear the Dow? It's been around for the longest period of time. The S&P 500 is, an upstart. It's only been around, honestly, I don't know when it started, but it's got to have been around at least 50, 75 years now. It's an upstart. But it's interesting that we still refer to the Dow 30. So as students of finance and investments, you know better than that, right? You know that if you truly want the measure of the economy in the U.S., mind you, the S&P 500 is going to give that to you. Now, I'm not saying you should ignore the Dow or discount it entirely, but the fact of the matter is that the S&P 500 is a much better quality index. Not only is it the valuating that makes it better, but look at it. I mean, we're talking 500 stocks here. Is the vast majority of the market cap in the 30 Dow stocks? Yes, absolutely true. But do those other 470 stocks matter? Yes, they do as well. So S&P 500 is kind of our gold standard, even though when you listen to a news report, you might think differently. What else to say on that? Something else that S&P actually, Standard & Poor's has a committee that decides which of those stocks goes into the index. And the choices that they've made have strengthened this idea that they're focused on the U.S. economy. In fact, a number of years back, they actually threw out about 15 or 20 stocks that were foreign domiciled and had the majority of their returns were generated from foreign earnings. They threw those out and said, we're going to replace them with other stocks that we think are more representative of the U.S. economy. So, they're focused on that, trying to build a better mousetrap, if you will. All right. One other thing to point out here is stale. Is an index accurate? Yes, for most part. However, you can get stale prices. And by stale prices, it's sort of like day-old bread. The bread is from yesterday. Well, the price was from yesterday or earlier in the day. If the market has moved on, then if we don't have a current price, which if there isn't a trade, we can't have a current price. The most recent trade might have been an hour ago, 2 hours ago, in the morning. And so while I say the S&P 500 is the best representation of the U.S. economy as a whole, because there are 500 stocks in it, because the stocks that are the smaller of the stocks in that 500 group, some of those stocks may not trade for an hour or two. And so as a result, there may be some stale prices within the index. I'm not as worried about that stale issue in the S&P 500 because those small stocks have such a tiny fraction of the value in the overall index. It's probably not going to matter much. Now, let's get on to actually some exercises, which is the homework that you've worked on as well, and look at how we construct these various indices. So here we've got Boeing, Nordstrom's, and Lowe's. And we're going to construct a price-weighted index, that is like the Dow 30. And the easy way to do this, like I said, it's very easy. All you have to do is buy one share of each thing. And so for $131.13, we can get an exact replication of this index. Now, if we have more money to use, and in this case we have $1 million to use, then we're going to take that $1 million and we're going to figure out the percent weighting. So this 51.48, that's the $67.50 stock price divided by the aggregate stock price. And that's our 0.5148. So 51.48% is how much money we put into Boeing. So that would be 514,800. Oops, can't write there. $800, and we're going to divide that by the $67.50 per share, and that's going to give us 76.26 shares. Now again, because it's a price weighted, and it's one share of each, or two shares of each, or 76.26 shares of each. So we already, once we've calculated that for one stock, we know that's the same for the other stock, and that will allow us to put our entire $1 million to work in this price-weighted portfolio. Now, the next thing we want to do to have an index is we have to have some sort of beginning value. The typical way to get that beginning value is to simply start off by dividing by the number of stocks in the index. Here we have the three stocks. We've added up the prices. The typical way to start this thing off is to simply divide by the number of stocks in the index for a price-weighted index. So here we have three stocks, so we're dividing the 131.13 by 3, and that gives us a beginning value for the index of 43.71. So everything is off a base of 43.71. Now, if we go to the next day and we update our prices, we see it's, sorry about that. I'm on the wrong slide. Here, actually, what we would like to do is we would like to change one of the stocks out. So we'd like to replace Lowe's with Home Depot. Now, here's the problem that we face with that sort of change, is that the price of Lowe's is different than the share price of Home Depot. So we're actually going to be putting more weight into the Home Depot. So that's $32.90, whereas the Lowe's price is $21.70. Clean that up a little bit. So how do we manage that? We don't want the value of the index to change, because all we're doing is we're taking out one firm and replacing it with another firm. So again, we're just going to add up the prices, and now instead of 131.13, we get 142.33 as an aggregate price. And we want that 142.33 to end up with a value that is equal to the value that we had before we replaced Lowe's with Home Depot. And so we're looking for a divisor that will give us that value. Given that the numerator is 142.33, what divisor will give us a index value of 43.71, and that divisor turns out to be 3.2562. Okay, so we've replaced one stock with another, but we haven't shifted the value of the index. Now, the next day, we're going to add up all the new prices. We're we're going to come up with a new index value, and then it's ending minus beginning over beginning. It will give us the percentage change in the index. So that's the only trick here is when we actually change one of these out. The other problem that we have with price-weighted indices is if the company, one of the companies in the index does a stock split. We have the same sort of problem, right? Because their price goes in half or 1/3 or 1/4, depending on whether it's a 2-for, a 3-for, or 4-for-1 stock split. And as a result, if we didn't make some adjustments for that, it would cause our index to change value. And in fact, nothing changed. All we had was a stock that split, right? So we do a similar adjustment to the divisor to make sure that the index level doesn't change as a result of either changing out any of the individual components or because a particular component did a split. Now, if we're looking at doing a value-weighted index, here we start off with the same set of firms, Boeing, Nordstrom's, and Lowe's. Now we also need to know the number of shares outstanding, and that will allow us to calculate the market cap. And then we take that total market cap down here, so we're adding up all of these, and we end up with a total market cap for our index. And then each firm has a percent of the total market cap. So this 0.555, 55.5%, is 49.46 million divided by 89.110 million. Or I could say 49.46 billion divided by 89.11 billion. That's 55.5%. Likewise, we do that for Nordstrom's, we do that for Lowe's, and here's the percent that we put into each of those. So now with the value weighted, we're putting in our money based upon the percent of market cap that they make up of the total index, which is a much more sensible way of allocating our money, especially if our goal is to have the index perform relatively the same as the economy in the area that we're working in. So now you'll notice that the number of shares that we buy is very different. Now, here's the problem with the S&P 500. I can't replicate that index without having millions of dollars. It takes millions of dollars. And even then, my transaction costs are huge. I'm buying and I have commissions for 500 trades each time I want to make a trade. Now, granted, once I've constructed that index, I don't usually have to trade it very often unless there's a change in the components in the index. So I can kind of follow a buy and hold, but still at the beginning when I create it, there are 500 commissions I have to pay. Also, because this is not 1 share of each or 2 shares of each or 100 shares of each, I might have to have a couple of $1 million to even come close to getting the right percentages here, right? Remember, we're talking about 500 stocks in the S&P 500. So that's a real problem. Except, why? Why isn't it a big problem for you and I? Even if we've only got $10,000 to invest or $1,000, how can we avoid that replication problem? What tools do we have available to us in the marketplace? Noah, any ideas?
Would options be an option?
Yeah, you could do an option, but that wouldn't necessarily get us exactly replicating the index itself. That would add some leverage to it. What would the option be on? You're buying an option, but what's the underlying asset in the option itself? I know I didn't have you read chapter 4. The hint is in chapter 4. Brett?
Mutual funds and stuff?
Yeah, mutual funds, and even better than a mutual, well, not better, but even easier than a mutual fund, an ETF, an exchange traded fund. So there are numerous ETFs out there that track the S&P 500, and they've got tens, if not hundreds or billions of dollars, hundreds of millions or billions of dollars in their portfolio. So they're easily replicating that. Their transaction costs are much lower than ourselves, and we only have to pay one when we buy the ETF. So we've got a way around that. Now, the other thing about a value-weighted fund, and we could really do this with the price-weighted fund as well, but the value-weighted fund, they usually start off with some sort of round number. So here we're simply using a divisor of 89.11 with a numerator of 89,110. So that gives us a beginning value of 1,000. We could set that to 10, we could set it to 100, whatever number we want. We just pick the divisor. And yet we're going to use that same divisor, though, for all subsequent calculations. So I add up my total market value at the end of the second day, and I divide by my 89.11, and I get a new index level of 1,012.33. So it's gone up by 12.33% in that one day. All right, so this is where we're going to use that value line sheet on the AMEX. So first thing we're going to do is figure out the K. And for that, we need to know a couple of things. We need to know the risk-free rate, which I'm giving you as 3.75%. We need to know the market risk premium, which is 7%. And what else do we need to know? One other item.
We need the beta.
Yeah. Thank you, Noah. Yep, so we're looking for beta. So let's go over to, where did it go? Here we are. All right, so there's our beta up there in the upper left corner. I've highlighted in yellow. It's 1.1. And I don't know why Valueline thinks they need to put in there that the market beta is 1. It's always 1. We know that. For a page that is highly densely packed with relevant and pertinent information, here's one spot they could have avoided, but be that as it may. All right, so now let's go back and calculate our K. So here's our capital asset pricing model, and we plug in chug, and we end up with a K of 11.45%, or 0.1145 in decimal form. All right. So the next thing we want to do is estimate some sort of growth rate. In this case, we're just choosing to use the sustainable growth rate, or at least initially look at it and see what we get. And the sustainable growth rate is simply the ROE times 1 minus the payout, or we could also look at that as the ROE times the retention rate. So think of that as this is the amount of money that I'm keeping in the company. And if I grow capital at the rate of the return on equity, then that money should grow at that rate, and that will allow my firm to grow. So that's why they call it the sustainable, because it's organic growth from within the firm. I'm not issuing new securities. I'm not taking on new projects necessarily. It's just the ongoing rate. So when I look for those numbers, I'm looking for ROE of 20, and I find that it's 29.5. I find that the dividend is $1.85 on an earnings of $9. So let's go back to our AMEX Valueline page here and see where those numbers come from. Like I said earlier, the nice thing about this page is that it's just densely packed with information, but that's why you need to go and learn how to read this thing first. So we see over here, we've got $9 for earnings per share, and we've got $1.85 for dividends declared per share. And I told you the year to use, so we're just going down that column. So there's our payout ratio, 185 over 9. Now for return on shareholder equity, we go down here, and the appropriate one to use in this case is the return on shareholder equity That's a little different than the return on common equity. And again, unless I tell you differently, always just use the return on shareholder equity. Most often that's the same, but in this case, there must be some preferred shares out. So that's causing there to be a difference between the overall equity picture and the common equity. But in most cases, they'll be very close to one another. So that's where our 29.5 comes from. And then we do the calculation, and we end up with a growth rate of 23.43. Okay. That'd be all right if that wasn't greater than K, right? And if we're trying to do the dividend discount model, one period constant perpetual growth version, we can't deal with that. We can deal with it in other versions of that model, but we just can't deal with it in that particular model. So let's try something else. Let's calculate the geometric average growth rate of dividends from 2015 to 2020. All right, so where are those? So here we have 2015 and up to 2020. Here's our dividends over that. It started at $1.10 in 2015, and it climbed to $1.85 in 2020. We only need those two endpoints if we're doing the geometric average. We don't need all of the intervening values. So we just need that $1.10 and the $1.85. And then we're going to take the ending value, the $1.85, divided by the beginning value, the $1.10. We're going to raise that to the 1/5 power, and that's because we have 5 years here. So it's 1 over, if it's greater than a year, instead of being a integer, that becomes a fraction. So if it was 3 years, it'd be 1 over 3. If it was 4 years, it'd be 1 over 4. In this case, it's 5 years, so it's 1 over 5, 1/5. You just put that into your calculator using the y to the x, and your x would be 0.2, right? So we plug that in, subtract back out the 1, and we end up with a geometric average growth rate over the 5-year period of 10.95. That's much more palatable, at least in the context of a constant perpetual growth dividend discount model. So we're going to use that. Now we want to estimate our value or our price, and we're using the constant perpetual version, or aka the Gordon growth model. So that's the dividend that we just had, which was the $1.85. And we're going to grow that at our growth rate of 10.95. Is that right? 10.95. We're going to grow that for 1 year at that rate. So there's our G. And then we're going to divide that whole thing by K minus G. And that's the closed form solution to the infinite series. When we plug and chug, what are you thinking is going to come out of this? Is this going to be a relatively reasonable number, do you think? Right. No. Yeah, I see. No, you're shaking your head. No, it's not going to be very reasonable because G and K are very close to one another, right? So it's probably going to blow this thing up. And yeah, just as we suspected, it blew it up to 410. Now, again, let's go back to our value line page. The most recent price, 117. Yeah, so this is ridiculous. We're at about 142 in the afternoon, so I think this is probably a good spot to stop. We're going to have some ways of improving this estimate, and we'll carry on with that on Tuesday. I'll also finish up talking about, just got a couple of things out of 19 and 20 that I want to emphasize. In particular, in 19, I want to talk about a little bit about the pro forma financial statements. I think that, I don't know if that's something that they cover extensively in accounting for for finance majors, the AC 310. Have any of you had AC 310? Did Dr. Sheely or whoever you had talk at all about pro forma financial statements? Do you recall that? Okay, so we'll talk a little bit about that on Tuesday, and then just a couple of items to pick up on chapter 20. That's now, don't misinterpret this as meaning I'm not going to put any weight on those two chapters. I am. I'm just assuming that reading and working the problems is going to be enough. If it isn't, and you've got specific questions, make sure that you let me know. And by the way, I also have to get back and get up to date on the discussion board, so I'll be posting some things on that over the next couple of days too, and I may see some of those questions in there. All right, I think that's it. You all have a great weekend, and I will see you all on Tuesday. And I'll set up another Zoom session for Wednesday. We said at 5:30 for a group review session. And if you want to do anything over the weekend, feel free to email me and we'll get something set up then. Otherwise, happy studying. Have a great weekend. Bye-bye.
Thank you.
Thank you.